Hi friends, how are you? By blessings of the God, you are doing well. Once again, I am welcoming to all of you Dr. A B JENA classes, and today we are going to discuss the very vital, or 12 concepts and the terms which are very vital, and always students are requesting me kindly you prepare and post the on the various terms and concepts which are related to the commerce management PMR subjects are concerned, and this lecture will be helpful not only for the academic purposes but also for the lectureship exemption point of view, as well as the UGC net and JRF point of view. Okay, so dear friends, without delay we will start our discussion. Just you spare 10 to 12 minutes, you will get more idea. Okay, so before discussion, kindly you take the screenshot. Okay, the first one is that is the serial number, the terms or concept. So it's the concept, terms or concept. Then it's the part one. So again you will the very soon you will get the part two of the various important terms or concepts which are related to that in the commerce management economics PMR subjects are concerned. Okay, so first one is that is the share warrant. What is the meaning of share warrants? So I have already posted the video what is the meaning of shares, and what are the different types of shares, and what is the basic difference between the shares as well as the debenture, preference shares and the equity shares. Okay, share warrants. What is share warrants? So share warrants, it is a document. Share warrant is a document as well as a negotiable instruments. So share warrant is a document as well as a share warrant is a negotiable instrument which is issued by a company. CO stands for company. Okay, under its common seal. So company has its own seal. Share warrant states what is this, that its bearer is entitled to stock or share specified there. So it's the meaning of a share warrant. So I mean how many shares are there. So just so it will be mentioned in the share warrants. Okay, come to the second one, the vital term or concept, dividend warrant. What is the meaning of a dividend warrant? So dividend, with regard to the dividend, so normally dividend is a reward which is given or which is paid to the equity shareholder. As again I am repeating, okay, on dividend I have already posted one video what is the meaning of dividend and what are the different types of dividend. Okay, so here normally there are two types of shareholders. First one is that is equity shareholders. They are the owner of the company and they will not get the fixed rate of dividend, whereas so in preference shareholder they will get the fixed rate of dividend. But the issue is where so the how much the dividend will be paid to the equity shareholder. Okay, so the dividend will be payable to the equity shareholder on the basis of or the availability of a company profit. Okay, reference come to here. So dividend warrant. So dividend warrant is also a document like the share warrant, which shows dividend warrant shows that a shareholder is entitled to get the dividend from company profit. CEO stands for company profit. So here the dividend warrant clearly clearly mentions so what would be the dividend paid to the or will be payable to the shareholder. Okay, dear friends, now you are clear. So next one is that is customer and consumer. Always you will get the question or you will in the interview board also you will get the question what is the basic difference between a customer and a consumer. Okay, dear friends, customer is a person or a person who buys the goods or services from a shop or a business. Okay, known as the customer. So customer may be the user, I mean the consumer. Okay, so here the consumer, what is the meaning of consumer? The person who finally consumes or uses the goods and or the services. Let's take an example. Suppose you will purchase a goods for your own use. So in this situation you will be treated as both the customer as well as the consumer. Okay, so another example, suppose you will purchase something, maybe a smartphone, maybe a chocolate, maybe books, or it may be the dress, and suppose you will give the gift to your relatives or to your brother or to your sister or to your parents. So in the situation when you will purchase and you will not consume it, so in this situation you will be treated as, or you will be known as the customer. And you will give to whom? Okay, suppose you will pay to your brother, and your brother will be the consumer in this situation. Okay, now dear friends, now clear what is the basic difference between customer and consumer. Okay, by citing the suitable examples, now you are clear. Okay, now we will move towards the fifth one term or concept. It's that is the finance. So finance is the lifeblood of the business. So right amount of the finance is must to a business organization. So that is the most important decision. So it's that is the that is the investment decisions. These are the important decisions. That is the investment decisions, financing decisions, and the dividend decisions. So here, so what would be the your capital structure? There should be the right amount of the capital or the adequate capital or the finance or the fund. Otherwise, so the growth and development or objectives of your business cannot be or may not be achieved in due time. So finance, what is this? The provision of money or the finance, it may be defined as the provision of money or the fund at the time when it is required. So the finance will be invested in the business in order to get more return, I mean to earn the more profit, and for the after that also not maximizing the profit, but also other objectives of the business can be achieved if there will be or there is the right amount of the fund or the finance, as well as so in order to in order to enhance the value of the firm or the market price of the share. So the finance, the role of finance is very vital. So the finance, the right amount of the finance is must to a business organization, to a firm or to a company. Once I am repeating, the finance may be defined as the provision of money or the fund at the time when it is required for the investment purpose. So capital structure. Capital structure, what would be that is the ownership capital, what would be the borrowed capital, and what are the different sources. So like this, so these will be taken into consideration. So next one is that is the financial engineering, AFE, financial engineering. So it's it's also very vital. It's very vital to know about this. The financial engineering is the use of mathematical techniques, to solve the financial problems. So yes, the financial engineering right now it's used in that is the in business, also economics. So these are the techniques. Suppose some innovative the mathematical models for the investment. So new investments, new what would be the innovative techniques for the new investment, as well as the new financial model. So these are some of the instance of the examples of a financial engineering. Once again I am repeating, financial engineering is the use of mathematical techniques to solve the finance related problems of a business or of a firm. Yes, next one is that is the zero based budgeting. So it's a ZBB stands for zero based budgeting. What is this? The promoter or the idea contributed, that is the Jimmy Carter in the year of 1962 from USA. So this concept has been developed or introduced by the Jimmy Carter in the year 1962. What is the meaning of zero based budgeting? So every year is taken as the new financial year, and previous year the previous year is not taken. Previous year is not taken as the base year. So every year, so it's that is the modern techniques, and the budgeting there are normally two types of techniques, that is the traditional budgeting techniques, and the second one is that is the modern techniques of capital budgeting. In a separate video we will discuss in separate video we will discuss in detail about the what are the techniques of capital budgeting, traditional budgeting techniques, and the modern capital budgeting techniques. So zero based budgeting, it's that is the modern capital budgeting techniques. In separate video we will discuss in detail. Yes. Next one is that is the capitalization. I have already posted one video with regard to that is the capital structure, what are the important factors. So they normally usually influence the capital structure. So there, by citing the suitable examples, so I have already discussed, already posted, and I will have the request, kindly you go through and you will get the more idea. Yes. So capitalization, what is this? The total amount of securities. Total amount of securities. What are the securities? That is the share, I mean the equity shares, preference share, debentures, and bonds is issued by a company. It's known as that is the capitalization. Capitalization, once again I am repeating, capitalization means what is this? The total amount of securities. What are the securities? It may be the equity share, it may be the preference share, and the debentures or bonds which are issued by a company. In order to finalize or to determine the optimal capital structure. Next one is the financial leverage. It's known as that is the trading on equity. So this question always or frequently you will get in exemption. In competitive exemption also, in UGC net also. What is this? So financial leverage or the trading on equity, what is this? It refers to the use of long-term interest-bearing debt. What are the long-term interest-bearing debts? So these are the debentures or the bonds or the public deposits and the preference shares along with the equity shares. In order to get that the return will be more, profitability position of the project will be more, and the market price of the share will be more, as well as the value of the firm will be more. So in this context, the financial leverage or the trading on equity is very vital to the business organization. Dear friends, in separate video we will discuss what is the meaning of leverage and what are the different types of leverage: financial leverage, operating leverage, and the combined leverage, and the difference between the operating leverage and the financial leverage. In separate video we will discuss in detail there. Next one, it's a net interest income, NII. Net interest income. What is this net interest income? So normally this term is also used, and it's also very interesting to know. Normally in the banking business, in banking sector, so this term is used to more. What is this? NII is the difference between D/W. It's the between the interest incomes a bank earns from where the loans and advances, as well as let's take an example. Yes, loans and advances. A bank has a bank has given 100 crores loans and advances to the customers. So in this situation, the bank will charge the interest on the loans and advances. Yes, normally the interest on loans and advances are more than the interest paid on a deposit amount. Yes, first we have to complete it, then we will discuss. So NII is the difference between the interest incomes a bank earns from loans and advances and pays the interest to the depositors. In mathematical equation, NII, what is this? NII will be calculated or will be measured interest earned minus interest paid. Interest earned and interest paid. By citing the examples here, 100 crores. Suppose the loans and advances, a bank has given how much? 100 crores loans. Suppose 10 crores will be the interest. or loan amount 10 crores, and here and similarly the depositor or customer will deposit some amount. It may be the RD, it may be the fixed deposit, it may be the savings bank account and the other, okay, the banking product. So there the bank will, suppose the bank will pay the interest to the depositor. Let's take an example, that is the 80 crores. So difference between 10 crores and 2 crores is that is the 2 crores, 8 crores, it's the 2 crores. So here NII will be how much? That is the 2 crores. So it's the 2 crore is it is the net interest income to the bank. So dear friends, now you are clear. So NII, it is the difference between the interest incomes a bank earns from the loans and advances and pays the interest to the deposit. So by citing this example, so 2 crore is the, or 2 crore will be the net interest income to a bank. Okay. Next one, concept, or the concept is, what is this? LBO. LBO stands for leverage buyout. Leverage buyout, what is this LBO? LBO, it is a strategy. LBO, it is a, okay, business strategy, and which involves the acquisition of another company by using the substantial amount of dead capital, or it's a or the borrowed money. Yes. Regarding this, I have already posted one video. What are the different types of merger and what is the difference between merger and acquisition. So definitely I will have a request to all of you, kindly you go through there, then you will get more and more ideas. So normally LBO, when, let's take an example, A company will acquire the B company and A has to pay the amount to the B company. So here what happens? So A company will raise or borrow the money from the financial institution, or from the financial institution more amount from the financial institution in order to A will pay the business value to the B company when A company will acquire to the B company. So that's why LBO, it is the financial strategy which involves the acquisition of another company by using the substantial amount of debt capital. So here when A company will acquire the B company, so A company will require the huge amount of fund or the money. So in this situation, A company will borrow the loan from the financial institution, as well as A company will issue again the bond or the debenture to the general public. Then after getting the right amount, then A will pay the final amount or consideration or to the B company. So now you are clear. So last but not the least, it's the hypothesis. What is this hypothesis? And always that is the hypothesis is very, very vital, and I think you have more or less about the idea about the hypothesis. What is this hypothesis? It is a tentative answer. Again I am repeating, hypothesis, it is a tentative answer to a question or a problem. Or hypothesis, it is a statement, or hypothesis is an assumption that is made based on some evidence. Okay. So here some research question will be formulated in order to prove or disapprove. Yes. So by taking in the variables, it may be the dependent variables, it may be the independent variables. Yes. So hypothesis, it may be the null hypothesis and alternative hypothesis in a separate video we will discuss in detail. So these are all about today's discussion. So far as we have covered the 12 terms or concepts which are related to the financial management, mostly the financial management, and so far as the commerce management, PMR and the economics subjects are concerned. So once again, thanks a lot to all of you. If you like this video, kindly you share it, kindly you subscribe it, kindly you forward it. If any gap if any gap is there, kindly you just give your valuable comment in comment section. So once again, thanks a lot to all.